All right, let's go ahead and get started. My name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive tech since 2004 for a large audience of global and retail institutional investors. So today we're going to talk about ARK Invest and in particular why their ETFs are falling. Now that's a bit of a clickbait title. We're certainly not trying to jump on the bash ARK bandwagon. So a lot of pundits lately have been criticizing the performance of ARK's ETFs. Here we have Jim Cramer. Look at the bags under that guy's eyes. Certainly, he was out on Thirsty Thursday. Of course, we've all been out there on Thirsty Thursday and had to work Friday and use the side door so Lumberg don't see him. Here's Jim Cramer pouring some cheap whiskey on a little model he's made of ARK there, representing ARK stock picks, and a bit of a showboat that Cramer is, but apparently, he's wasting ethanol and oxygen, telling us the obvious, which is that ARK's ETFs are falling. Now, the last time we took a look at ARK was back in May of 2020. And at that time, we had a position in ARK's innovation ETF. We sold that and we put the money into a stock and a different ETF. And we had commented that when you're looking at the amount of money that ARK has in their ETFs, when ARK throws money at a stock, that stock price is going to go up. So when they decide to invest in a stock, then they have to buy it for their ETFs, and that the rising tide lifts all the boats. So some of the stocks that they've added to their ETFs, an example might be Organovo or Nano Dimension stock, that both stocks not having a real vision about what they plan to do with their businesses. That helps the price of those stocks go up, but inevitably these companies need to figure out their way forward. So ARK ARK's ETFs resulted in a lot of money going into a lot of different stocks. And the point that we made back then was that if you're holding a stock that ARK is holding a large position in, or even ARK is holding, period, it better be one that you're willing to buy at a cheaper price, because it's probably going to get cheaper eventually when the hype dies down. And indeed, we see that happening today. Now, criticism of ARK back then, we in the same piece, we pointed out a number of criticisms about ARK. One was that they were taking a large free float, a percentage of the free float in certain stocks. Here you can see the quality of individuals that CNBC hires to produce and vet their charts, but Statusis and Photo Labs. So those were two companies that ARK had a great deal of ownership in. That's a lot when you own, a fifth of a company. So that could potentially be problematic. We've seen how Proto Labs, the shares have sunk quite a bit, and that no longer is one of their top holdings. Perhaps they were selling it, and that selling pressure helped push down the price of that stock. Now, we mentioned Organovo earlier. An example here is that ARK says, shares of Organovo are going to be volatile until they reveal plans about their path forward. Well, that's kind of a problem. You shouldn't be investing in a company that doesn't have a plan, right? So both Organovo and Nano Dimension are stocks that don't really have a strategy. Organovo's very small. I believe they're sub $100 million. We wouldn't invest in anything under $1 billion, and that's surprising that ARK hasn't set a size rule. ARK likes to take on a lot of risk. That was the title of the research piece that we wrote in May of 2020, was ARK's appetite for risk. So at that time, we took a look at their 5 ETFs. So the space ETF hadn't come out yet. And then along the top here, you can see their assets under management. On the left here, ARK, ARKK, that's their flagship innovation ETF. What we did here is we looked and said, all right, let's take the top 15 stocks across their top 5 ETFs, and then let's see how many stocks can be found across these categories, right? So 5 ETFs out of the top 15 positions for each. How many duplicates do we have? So stock that's being held in more than, let's say, 3 or more ETFs is marked in pink. A stock held in 2 or more ETFs is marked in yellow. So not a ton of crossover. We can see Tesla's crammed into 3 ETFs there, and looks like Teladoc, the same thing. So there was certainly some crossover. We're going to look at that later, how that's changed. Now, another piece we pulled up from Morningstar was critical of ARK, the lack of risk control. So the fact that ARK takes on a lot of risk certainly implies that they don't have a lot of risk management in place. And this gentleman here was criticizing personnel. So his criticism, I think, surrounded the fact that not a lot of people on the team had advanced degrees, I think was his point of contention. Now, that certainly doesn't matter. Anybody who's taken an advanced degree in finance knows how little you learn from that. It can potentially be damaging. As the old saying goes, you got the guy going in his Bentley into the financial services firm to learn about successful investing, and the gentleman going to meet him is taking the train in to work. So the fact that somebody doesn't have a advanced degree doesn't necessarily mean much, but some of the criticisms are probably valid. And this is one example that we cited in that piece. And this was an analyst at ARK talking on Twitter. This gentleman, at least used to be fairly active on Twitter, calling out the CEO of a particular company and saying, and you can read it for yourself, I'd love to speak with CEO if possible. I've got lots of questions, and as always, I'm keen to learn. So first of all, you're not going to learn anything from talking to the CEO of a company. These people are trained to talk to the media. They know that your firm commands a lot of capital, and they're salespeople. They're going to feed you what you want to hear. Incredibly, when that happened, when that gentleman from ARK made that comment, look at how the share price reacted. This was quite a small company. And then on the right here, this chart, you can see where that peak was, about the center of that chart, and look where it's at today. So it went from, above $10 a share down to below $2 a share today. That's all hype. And when you go and make comments like that on Twitter and a share price reacts accordingly, then that's pretty obvious that is hype. Now, this same gentleman who likes to go out and talk to CEOs can be seen here having a good old time with the folks over at Ginkgo Bioworks. So when, you have to ask yourself, when Ginkgo Bioworks was criticized by that research firm, Scorpion Capital, alongside Berkeley Lights, if you have a relationship with the management team at either of these companies, how comfortable do you feel then, turning and being critical? You think you're not going to get a call from this gentleman here saying, hey, what are you doing, man? Why are you talking smack, right? So these informal relationships often come into play and make it very difficult to be critical about firms you're covering. We would never speak to a publicly traded firm that we cover because we don't believe that adds any value. You can go through their investor decks, you can go through their SEC filings, particularly the latter, and learn everything that you need. So let's fast forward to today. And what we want to do today is look at what's been happening with ARK. So everybody talks about how the sky is falling, but is that the case? So first of all, let's look at how the assets under management have changed for ARK's ETFs. So back in May 2020, we had looked at the AUM for ARKs, and I just want to make sure that, in fact, that's 2020 or 2021. And I'm just going to pull up our piece and make sure that, in fact, that is 2020. And it's 2021. So my apologies earlier when I referred to that as 2020, I meant 2021. So be that as it may, in May of 2021, this was the measurement of assets under management for their ETFs. So this is how much investors had put into their ETFs. So you see for the flagship there, 20 billion, that's big. And that's a big ETF. And then down, you got their genomic revolution, next gen internet, et cetera. Then what we can do is go today and just take the AUM right off their website and see how much that's changed. So you could see that for the flagship ETF, about 20%, and the genomics ETF, 37%. Now, you can't assume that that's because investors withdrew money. And this becomes really tricky in a hurry, and it's important to distinguish between two terms here. First is net asset value. So if we just froze everything in time and took a look at ARK's ETFs, they're a collection of stocks. There's a price of the stock, there's a number of shares they hold, and that's a dollar amount. If you added all that up, that's the net asset value. Then, separately, if you look at the amount of money that investors have poured into ARK's ETFs, that's called assets under management. Now, those two numbers should be fairly close. And we pulled this sentence here, I think that was from Investopedia, and it says it pretty well. It says redemption mechanisms keep an ETF's market value and NAV value reasonably close. So are investors pulling a lot of money out of ARK's ETFs? Well, they refer to that as outflows. And ETF.com has a tool you can use. And all we did here was look at the outflows from May of 2021 until today across all of ARK's ETFs. And there's, I think, a total is about $7 billion. And that's roughly what we've seen other pundits comment on. The reduction for their flagship ETF is not very much at 12%. And then it grows as you go down. The ETFs, the smaller they get, the higher the redemptions have been. So there's some contribution to the reduction in AUM by the outflows, but there's also stock price performance that needs to be taken into account. Now, remember earlier we talked about stock concentration. So we said we're looking at the 5 ARK ETFs and seeing where the overlaps are with particular stocks. That was back in May, and you can see what we came up with here. Now, the concentration today is a lot stronger. So first of all, they've got UiPath in every single one of their ETFs. They've even crammed it into their space ETF. You could make an argument that, because UiPath is robotics process automation and that's industry agnostic, potentially it can affect every single sector. Okay, fair enough. But is Teladoc really a fintech company? That's hard to say. So let's say that's a hard argument to make. So you could see here that the concentration has increased significantly. And what that means is when a particular ETF experiences outflows, that affects the constituents of all their other ETFs. So basically speaking, ARK's risk has gone up. Now, ARK loves risk. They're hungry for risk, so that shouldn't be a surprise that the stock concentration is increasing their risk. They're isolating their bets and hoping that the companies that you see on this page are going to be quite successful going forward. Now, if we look at how ARK's ETFs have been correcting, this is an interesting chart. This is their flagship ETF, and where that red arrow points, that's where the quote unquote correction was for the coronavirus. That was in January, February, March, April, March of 2020, when the market corrected and then quickly recovered. You may recall when that happened. And look what's happened since then. So ARK's ETF just rocketed. Now, some of that performance is attributed to names like Zoom or Square or Teladoc that were benefiting from the COVID thesis. Now, we've always argued that the COVID thesis should be looked at as temporary. So one thing you could speculate here is that the correction that you're seeing from ARK's Innovation ETF is simply the hype around coronavirus names and that temporary benefit that was realized by those stocks, and now everything's coming back down to where it should be. In fact, if you take a broader look at the market and say, what actually happened with the pandemic? Well, the travel industry was decimated. We're still seeing the bullwhip effect take place in supply chains. It's impacted the entire planet in ways that we still don't know. Why should the stock market be on an absolute tear after that happens? Why wasn't there a proper correction? So you could almost argue that perhaps stocks ought to not trade higher than they were prior to the pandemic. That would mean that the pandemic hadn't had any effect. So I think right now the ARK Innovation ETF is up 19% over what it would have been right before it had that little mini correction that the red arrow points at. So the quote unquote that correction that we're seeing today could be seen as something that's expected. Now, the other thing we need to consider here is how are ARK's ETFs correcting in relation to how the overall market is correcting. So if we look at the last 3 months for ARK's innovation ETF, it's down 43%. That's a pretty big number. But then if we look at the NASDAQ, that's down 11%. So technically we should remove that overall broader market return from ARK's return, which means their ETF is only down 32%, which is still around a third, which is still quite a bit. And we can also see here that the S&P 500 is barely reacted. So we need to take that into consideration. Now, when we look at the top 15 names in ARK's innovation ETF, the real returns, so we've taken the 3-month return and then we've removed the NASDAQ return, you can see how these have fared, and some of these names have gotten hit quite hard, Zoom and Teladoc, and where is Square? We're calling that Block now. These renames are just ridiculous. So Block and Zoom and Teladoc, all coronavirus plays, are being hit pretty hard. So it shouldn't be a surprise then that ARK's flagship ETF corrects alongside the market, and because of a concept called beta, which refers to the extent to which a stock will rise and fall based on what the market does. The market goes up a little bit, a high beta stock goes up quite high. If the market falls a little bit, a high beta stock falls quite low. So it shouldn't be a surprise that we're seeing very risky assets fall in the manner that they are. Now, the other thing to concern yourself with here is that there really hasn't been much of a correction. So here's a look at the QQQ. This is the NASDAQ 100 index. It's an ETF tied to the NASDAQ 100 index. We like to use that as a benchmark, as a simple benchmark. And you can see the red arrow points to the coronavirus correction, if you will. And then on the upper right here, you can see where that blue dot and the little green flag is. That's where we're at today. So look at the NASDAQ has just barely corrected. And for it to fall just to get to the levels prior to the coronavirus correction, so to the left of that red arrow, that little peak right there, it would need to fall about 40% more. So anybody that thinks right now we're undergoing a correction needs to take that into account and under consideration. So this all comes down to, unless you're comfortable with large drawdowns, you shouldn't be invested in tech stocks, and you shouldn't be invested in ETFs like those on offer from ARK. So when the tech market corrects, these growth stocks, and you can get into the economics of it, higher interest rates and all that, but the reality is that if you're not comfortable with drawdowns, you shouldn't be invested in these stocks. And this is why you invest in quality names, right? So when this sort of stuff happens, you're confident that the stocks you're holding are going to be resilient in the long term. So that's about all that we wanted to say about ARK's ETFs today. Go ahead and subscribe to our YouTube channel. We'll be putting up more videos as time goes on. Thank you very much for taking the time to listen to us today.